Today, we're going to focus on the ISM numbers coming out of the US to do with how manufacturing is doing in the largest economy in the world. And then today's trading takeout is going to be, let's try and do fewer stupid things in 2024. And I'm going to show you exactly what I mean by this. Make sure you hit subscribe to get the best trading and market information and news every single day right into your YouTube feed. So today at 3 p.m. UK time, we've got the US ISM manufacturing numbers coming out. And this includes employment, it includes new orders, it includes prices paid, and also the PMI, which is the most important one. Now, when it comes to the PMI numbers, it's a diffusion index, okay? So basically what that means is anything above 50 is in expansionary territory. Anything below 50 is in contractionary territory. So we can see here that the key number has an expectation of being in contractionary territory at 47.1, and that's actually a percentage as well, with the previous being at 46.7. So it's better than previous, the expected number is, but it's pretty much basically the same, but still contractionary, okay? Now, let's flip this. Let's now look at this, okay? So this is the most recent manufacturing PMI on a general basis. So this is showing all of the global countries that we see, the main economies, okay? And we can see that the US is actually doing okay. The UK is doing much better than a lot of these other nations in Europe, for example. But we can see that the US is not doing too badly just yet. So if we take that thing that I was talking about for months last year, how markets move based on expectations versus surprise. And we start thinking, oh gosh, the USA, what if they start matching Germany's manufacturing PMI or Austria's or France? That's when we start getting the big moves and the big upticks in volatility. Over the last couple of days, obviously the very start of the year, we've not had that much data to go off of. So we haven't had that much surprise, barring the Red Sea stuff that's going on. And even then, that's not been too expansionary, or there's not been that many developments coming off of that. So what we have to pay attention to here, in my view, is absolutely any form of surprise coming off for the USA. Now, if we go back to the prices paid as well, and perhaps later on as well, the employment index, which should be quite important too, we can start to see maybe a picture of inflation and the relationship between inflation and employment. See, we're still in contractionary territory here with regards to the prices paid. And this is very specific to producers. It's quite important for the producers as well. Because if we were also to look at producer price index as well, if I can get a good chart of it, let me try and find one quickly. US PPI, there we go, year on year. Let me just flip over here. We can see that there's been a broader based collapse in producer prices over the last year, and this tracks CPI. So if I also put US CPI here, let's find the correct one firstly. US CPI, let's just find the median. There we go. So you can see that the collapse in CPI, this is the median, so it's slightly off. But the collapse in CPI basically follows the collapse in PPI. So the prices paid is a nice measure as well of where inflation's going and whether we've had any sort of pause or increase or even decrease in the rate of inflation collapsing. So it's quite an important number coming out today. And it should be quite a good as well anchor for the next week or so, because what the market is focused on now is how fast the Fed might start to cut rates. If we look at how the interest rate futures curve is priced, it's been brought forward massively in terms of rate hikes. We're looking at May, I think, for the first cut. And there's some banks that are suggesting 2.25% is meant to come off of the peak rate in 2024, which is a bold call. I think Wells Fargo made that call, and I don't necessarily believe that. I think that's way, way too aggressive. But we're seeing what the psychology of the market is right now. We're seeing that there are some people that think we're going to go into an aggressive rate cut cycle, which the reasons for that could be concerning. You know, if there were to be a liquidity crisis, we've seen last year, obviously, with Credit Suisse, with Silicon Valley Bank, that these were liquidity crises that needed programs like the Bank Term Funding Program to come into existence, whereby it just, basically created short-term liquidity. That's still running as well, that facility. And this is why whenever you hear rate cuts, you shouldn't say, oh, that means equity's up. Whenever you hear rate cuts, you should be thinking first, oh God, what is the reason for the rate cut? Because ideally, central banks want to keep interest rates as high as possible. It creates an efficient economy. It means that you're not getting, meme stocks rallying 500%. It means that you're not getting all of these ridiculous crypto coins that are going insane. A judgment on those is, it doesn't really matter. They are a trade at the end of the day, but they're still ridiculous. As long as you understand that they're ridiculous, that's perfect. Okay, same with, AMC, GME. If you understand that they're ridiculous businesses and they're going up because of mania, fine, recognize that and play off of it. But don't buy into the fact that these things aren't ridiculous. 5% interest rates are actually normal. So always bear in mind that I think when we're up here, central banks would prefer to keep rates up here at 4 or 5% than drop them back down again. It makes life a hell of a lot easier for them. But yeah, I think starting the year off with US ISM manufacturing is very, very important here. And I think the fact that Chinese factory demand has collapsed, I briefly mentioned this yesterday, I believe. The fact that Chinese factory demand has collapsed is very, very indicative of global demand as well. So do bear that in mind. The crux of this, though, is that it is expectations versus surprise always that creates the volatility for the trade to come off. You just have to find the relevant areas to do business at and pick the direction correctly, basically, which generally goes against the crowd. So find out which way the crowd's positioned, find a piece of information that is going to cause some volatility based off of that expectations versus surprise phenomenon, and then trade accordingly. One thing I think is really, really necessary, and this isn't just maybe, trading tips or investing tips, but it's to do fewer stupid things. And I really want to take that forward in 2024, not just with you guys, but for even myself as well. I think that if you're doing fewer stupid things, you're limiting your ability for loss. Okay. And unless the reward is excessively high for doing something more stupid than your average baseline of stupid, then there's no point in doing that activity. So I think in markets, for example, there is no point using excessive leverage on this one trade that you think you're really, really convinced on, because your risk of ruin just automatically goes up way, way higher. It's the same as if you decide, that you're going to deviate massively from the way that you normally trade. It's just emotive. It's silly. So let's try through 2024, not necessarily to reach for massive, massive goals, but just to limit that risk of doing something stupid. Do fewer stupid things.